Hello, good afternoon, and welcome to the Bitcoin and Gold Bold Index webinar. My name is Charlie Morris, the founder of ByteTree, ByteTree.com, and I'm joined by Alex Pollak, who spent 15 years at BlackRock and many years at iShares, so an expert in ETFs. And then more recently, he joined 21 Shares, which is based in Switzerland, which is our partner firm with the Bold Index. And what he doesn't know about ETFs isn't worth knowing. So we're going to go over the Bold Index and the rebalancing report this month and give people an opportunity to ask questions at the end about Bitcoin, gold, and Bold. Without further ado, this is, as always, not investment advice, so please don't mistake it for that. If you are new to this, what does ByteTree do? Well, apart from the Bold Index, we also have a research business. I've been writing the Multi-Asset Investor for the last 8 years. That's basically a UK-centric and European-centric portfolio service. We've got a gold report, Atlas Pulse, which I've been writing for 13 years now, it looks like, or 12 years. Venture looks at small and mid-cap European, US stocks, and then finally Atomic on Bitcoin. The gold and the Bitcoin are free to users, so please do feel free to sign up. The others are premium. 21 Shares, which is where Alex works, is based in Zurich. It also has a US office. They've launched 50 ETPs, exchange traded products around the world, in all sorts of things to do with crypto. And most recently, they've had a very successful launch with Kathy Wood's ARK in New York. The 50 products and $7 billion under management. A very successful firm. So Bitcoin and gold is gold. It's not gold, it's bold. And they're a natural pairing. And we bring them together because they're the world's two most liquid alternative assets. And quite simply, gold is very calm and quite reliable, and Bitcoin is volatile. But the great thing about them is they tend to be counter-cyclical. Although this year we have seen them move together, generally speaking, you could say that gold tends to go up and Bitcoin goes down, or vice versa. And we can show some of that later. And so by rebalancing, you're constantly buying low, selling high, and that's a profitable strategy over time. And so to rebalance your Bitcoin and gold holdings on a regular basis can lead to outperformance, and then historically it's done about 5% per year. And we're not the first people to observe this because, the great asset allocator of all time, Ray Dalio from Bridgewater, he said, I would take the gold and I would sprinkle a little Bitcoin into the mix too. And I think really from my perspective, this has always been a gold enhancing strategy. If you are a pure play Bitcoiner, go and buy Bitcoin. So what's the driver behind alternative assets? And what we've got here is just a sort of line, all the lines showing the money supply growth from countries in the G20, and the red dotted line in the center is basically the weighted average for the whole group. And there hasn't been any money supply growth for the last 3 years from the central banks on a net basis, and that really has been a driver of return. Yet there still has been quite a lot of liquidity in markets. So what's going on there? And I think really we have to look at deficits. And if you think about this, the US deficit right now is nearly 6% of GDP. Normal GDP growth, so growth plus inflation, is probably about that or a little bit less. And so there's still very much plenty of money going into the system. And so long as you have deficits, then there's more money in the world, coming through, and that puts a bid on asset prices. It's really when you tighten the system where things go wrong. And we keep thinking the system's tight because interest rates have gone up, but they keep being offset by something else. And so, we really haven't seen the sort of squeeze in markets that we thought we'd get in 2022. So anyway, with excess deficits, money print is coming back sooner or later. It does seem that there's a driver behind asset prices in general. And of course, the link to there is to inflation. And this is the US 10-year expectations for inflation. That's the black line with a moving average of 12 months in red. And what you see is that moving average has turned up again. So we had a surge in 2020-21, finishing with the Ukraine war. And then we've had the cooling off period, the transitory. But transitory is probably done. Global shipping rates at all-time high, copper, big move recently and that sort of thing. And what we're seeing is the break-even rates turning higher again. Now, I'm not saying they're going to shoot off, but just imagine if the money supply wasn't flat. Where would the inflation expectations be for the next 10 years if we actually had money printing coming through again? So that's what people are saying. Inflation's coming down, sure, but how long is it going to stay here? Given that we know that when the machine goes back into overdrive, it's going to shoot much higher. And I think that's really what's lifting things like gold and Bitcoin and asset markets in general. So, Alex, you remember this slide because Alex is here really to keep me company. And we've done many trips together, and you may have seen the picture of us swimming in Guernsey. I haven't actually put it into this presentation, you'll be pleased to know. But basically, he's heard this many times, and we've heard together many investors come to us with very good questions. So hopefully at some point he'll interject and say, pick me up on something or answer a question. But, Alex, can I just ask you about this diagram whereby, inflation's on the top, high inflation, low inflation's on the bottom. And we've basically got risk on the right, things like crypto and equities. And when things are going wrong, risk off, gold and bonds are supposed to do quite well. We've been on the risk on for the last 18 months for sure, since October 22. We've swung between inflation and low inflation and high inflation. It's not as clear as it was in 21, 22 with the inflation data, but we're kind of above the line, aren't we? And so how do you feel about the framework of where gold and Bitcoin sit compared to the other assets? And certainly when you were iShares, most of the product you were probably talking about was below the line.
Thank you, Charlie. And first of all, thanks for the kind introduction, and it's an honor to be here with you today. And of us swimming in Guernsey from a couple of years ago, I had to wear this suit off. But to answer your question, what strikes me when we've had meetings, across the UK, in the Channel Islands. There's still a lot of uncertainty about how to really define Bitcoin. Like, where does it fit in? Where does it sit within the portfolio? Do you define it as an equity? Do you define it as a bond? Do you define it as a commodity or a currency? So there's not a consensus answer about that. So I think a lot of the asset managers that you and I have met, are still trying to decide exactly where it sits within the portfolio, and if they are going to allocate to Bitcoin within the portfolio, what do you take out instead? I think though, if the answer that I've heard more than most though is a commodity. So you obviously often Bitcoin is kind of defined as digital gold by many. So I think for many, they do consider it to go within their commodity allocation. I guess my question to you, Charlie, as somebody who used to be a full portfolio manager and run a lot of money yourself, if you were running a portfolio today, a multi-asset portfolio, and you were going to allocate to gold or to Bitcoin more specifically, how much of your portfolio would you allocate?
Yeah, well, I think that's what the Bold Index does. So we'll probably come to that. But I say to you, Alex, and this was something said to me last night when you used to manage money. Well, I still do. I mean, I don't physically manage money, but I advise it to a large audience, and so I don't think that's any different. It's the same issues basically. But we have at the moment in our riskier portfolio, whiskey, then we have a small allocation to Bitcoin, yeah. And it's probably higher than it would be if I still worked in an institutional environment, because they'd probably, arm and arm about it. But I'll show you later that Bitcoin's less volatile than most of the large tech stocks. So, they'd be very comfortable with you having 5% in a large tech stock. So why not have 5% in Bitcoin? We've actually got a little bit more than that. But that's only because it keeps going up.
Yeah.
Well, let's move on. So basically, the point here is that, Bitcoin's risk on, gold's risk off. Both of them are somewhat inflation-sensitive assets, and expect them to be a store of value in an environment where the value of money falls. That's the point. The price of Bitcoin obviously has gone up a lot. Quite fun to look at it in gold. It went to 15 ounces in 2017, took a 3-year break, and then it went through 15 ounces in 2020. and has spent the last 3 or 4 years in that range of 15 to 35 with a little break in the middle. And I sort of think that we're probably going to be looking at this chart more closely as the years go by. Because I think that certainly 5 years ago, people just thought it was all about Bitcoin and gold didn't do anything. But now, people have been corrected. Gold can do something, and we expect it to do something. It will do something. And I think also it's my personal view that Bitcoin, although it's still an interesting thing to own, it's not going to have anything like the rate of return that it did 5 years ago, 10 years ago. I mean, that was a junior asset finding its feet in the world. That's when the best gains were made. But I think this relation is going to be really interesting. And the most important thing about rebalancing is that if you go up and down in these big ranges and you're rebalancing all the time, then you maximize value from that strategy. If you didn't rebalancing, you're not capturing the opportunity presented by the cyclicality of this relationship. Yeah. So, no surprise if you were engaged in a bold rebalance, a Bitcoin and gold rebalancing strategy with the bold index, your excess return is going to be maximized during those choppiest periods on this relationship. Pretty straightforward stuff.
So what you're really doing here is just kind of enhancing it's enhancements of gold, really.
Yeah. And I don't think, I'm not going to go and tell someone that this is going to enhance their Bitcoin. That's only going to be true if Bitcoin fails.
Yeah.
Which I don't think it will. But I think the expectation is that Bitcoin's a 25% asset IRR sort of thing, approximately estimate, who knows. And then gold's a sort of money supply asset, 7%, but probably with a bit of a tailwind in the next few years for reasons that I've written about before. In the process of going to a higher inflation regime, when that's recognized, then that itself is a very bullish proposition for something like gold. When the world's markets know that 2% is now 4%, that's a big deal. So I think that we have that to look forward to. But basically, you've got a 7% asset, roughly 3/4 in the portfolio, and then you've got a 25% asset, roughly a quarter in the portfolio. And if you do that, you sort of end, and with a bit of alpha, the excess return from rebalancing transactions, you end up at somewhere like 15. So it's an interesting place to be.
I agree. I mean, picking up. I mean, just picking up on the previous slide. On the trips that we've had, I think what has been also been very clear is that I think many traditional managers are just not yet allocating into the digital asset space. It's still such a new space for them, and they're still trying to get their head around it. And I think. We've seen obviously a lot of volatility over the last few years, but that volatility also is coming down. And I think, the allocations many are still not allocating. Those that are is very, very small. So this is actually a fantastic way, as you said in that first quote, it's gold with a little bit of.
Alex.
Sorry, go ahead. Keep going.
You froze briefly.
My connection's not great.
Okay, so moving on to the flows. Flows are really important because you've got to fight the miners in Bitcoin. The miners are there selling 450 Bitcoin every single day. And that's, it's quite a lot of money that totes up. Over the course of the year, at $70,000 Bitcoin, the miners are selling $11 billion or $11.5 billion worth of Bitcoin. That's got to be funded with inflows. We've done that thanks to Alex's old employer, 21 Shares, and his new employer, his old employer, iShares, who had the most successful ETF launch in history, and his new employer, 21 Shares, who both went to New York and launched their products, brought in billions and billions of dollars in January, February, March, and that's been amazing. So that really has lifted Bitcoin this year. And we've now seen those flows cool down in May and pick up again in the last couple of weeks with a spectacular week last week. We've had launches in Hong Kong, and of course we've had launches in London. Now the launches in London are, a pretty gentle affair, but I think that they could be something special one day if the regs change. But I don't really want to get into that because we can't speculate on that on areas we know nothing about. But basically, there's a wall of money coming when the world changes its view. And the thing about Bitcoin is it's the most underweighted asset on earth. It's a proper, serious, grown-up asset, and it's just not owned by pension funds or the wealth management industry. So, the idea that we can't sustain the inflows required is just laughable, and I think it could happen quite easily. So right now, Bitcoin's taking about 11 billion a year, and gold, we've had outflows, but the gold market, 2% new supply of gold every year is $300 billion. So actually, you need a lot of money to go into gold, which is fine because there is that money. $300 billion to the central banks is chump change. So this is the world that hasn't done much. Private investors don't own much gold at the moment. They've been selling it for the last 3 years, along with wealth managers, and they're just starting to pick up again. I hope, I think, and the Bitcoiners, they're doing their best. So both of these are heavily underweighted assets. Regulatory wealth management, fund management is heavily benchmark skewed these days. And so if the benchmark says 60-40 equities bonds, that's what they do. There's no room for gold or Bitcoin. But at some point, that's going to change. And I think that's really why the bull market continues for another 10 years. Bitcoin and gold. So, Alex, this is a new slide that we've come up with on the Bold Report, bold.report website, which is where we're going to put all our best stuff to make this argument about Bitcoin and gold in portfolios. And so we're just taking the last two slides, all the gold and ETFs, just under $200 billion, then all the Bitcoin and ETFs, around $70 billion, and then we add them together. That's our magic contribution to society in the green line. And that's a line that I think is just going to keep on rising, Bitcoin and gold. And you'll probably see more going into gold during the tough times and more going into Bitcoin during the good times. That's the expectation from here. So how do we make bold? Well, I'll go through this very quickly. I'm sure many of you are familiar, but basically the two inputs, the input is volatility of these two assets. And back in 2012 and before, Bitcoin was off the scale, crazy volatile. But now we're much closer to 40%, which, by the way, is the sort of upper end of where blue chip stocks lie. A very, very high quality stock would be about 20, maybe Nestle or something's a bit lower, but Procter & Gamble, these sorts of things. But basically, you call the Bitcoin a 40% volatility stock, which is below most small caps and mid caps. And in gold, we've probably got a 15 long-term volatility, something like that. And so we want to have more money into the stable asset and less money into the more volatile asset. Very simply, it's like a ship, and we've got lots of gold as our ballast, and our featherweight Bitcoin are our sails that are going to drive us forward. That's a sort of way to think about it. Some mathematics that we have to put our hats on, and we put in the volatility. So once a month we do this exercise. In fact, we don't do it. Our calculation agent, Vinta, in Sweden, do it for us. And they put in the volatility of Bitcoin over the last 360 days, and they do the same for gold. And they do this magic maths where they do 1 over 39.2 comes to 255, and then 1 over 12.6% is 7.96. You add those two numbers together, and then you just follow the calculation, and out comes the result. And every month we do this calculation, and the portfolio is rebalanced to those numbers. And it's a process that you do regardless of market conditions. It happens on the last day of the month. It happens at 3 p.m. The reason it happens at 3 p.m. London time is because that's when the London gold fix is. So it's the cheapest time, the biggest, most liquid moment in the day to trade gold in the biggest market in the world for gold. And so, these are both highly liquid assets, and 21 shares, of course, have got access to the big liquidity pools in Bitcoin. And so, we for a fraction of what a normal investor could trade, do this process of rebalancing. And the other interesting thing about that ability of 21 shares is they've got a product here with two custodians, which has never been done before. I mean, no one's got two custodians in their ETF, and so I think it's quite interesting that they've achieved that, solved this problem, being able to shift from one asset to another, which is much harder than it looks. The history of the asset allocation of the Bold Index. Bitcoin is in grey, and gold is in gold, and blue shows the performance of the index over time. Basically, in 2016-17, there was quite a lot of Bitcoin. Then in 2017, the Bitcoin volatility rocketed, and the weighting came down. It stayed low in the choppy bear of 2018, before gradually rising over the last few years. And even in 2022, when we had quite a nasty fall in Bitcoin, the volatility actually didn't fall as much. Didn't rise as much as it had done in previous markets, which really tells you that this asset is growing up. It can withstand price shocks and bad news, and it doesn't really impact the volatility like it once did. So it just tells you that $1.5 trillion Bitcoin is a proper grown-up asset. It's behaving much more normally than it used to, and to me, that's very encouraging. So a bit of performance data over the past 12 months. I'm going to show Bitcoin, gold, gold, and the World Equity Index. So over 12 months, Bitcoin up 149%, gold up 18. Now, if we owned a portfolio of 2575 of Bitcoin and gold, you've made 50%. If you own the Bold Index, which rebalanced in a strongly rising Bitcoin market, you actually did worse. It was probably the last year you were worse off by rebalancing by 2.6%. But it's really not very much at all. But that is an environment where Bitcoin absolutely surged. If we do that since the peak of 2021, same exercise, Bitcoin was up 49% since then, and I've actually got the wrong numbers on that. I apologize, because Bitcoin's not up 49%. It's up 6% according to that slide. Gold's up 49%. Gold's up 49%. I've made a mistake there. Sorry about that. I'll get that fixed. But there's a massive outperformance of gold over that period. In fact, that is the correct data. I've just written 49 on Bitcoin. Bitcoin was actually up 6%. Gold's up 32. And gold was up 50, as it says. And so there's a significant excess return from owning gold.
Charlie, on that, just going back to that, I think, what really strikes me about that specific chart is that, we are including the crypto winter in that. 2022 is when really, the bottom fell out of the crypto market. We had all the issues with FTX and Solana. It was a really volatile time. And I think, what when people are looking at this and thinking about the Bitcoin exposure, actually, it didn't really have that much of an impact. If you've held it over that crypto winter, if you held gold over the crypto, you're still, your performance is still stellar.
Yeah. Well, gold was never much worse than the stock market, right?
Yeah, exactly. But I think those numbers might surprise people because, in the UK, I think the investors that I speak to, I think there's still a little bit, there's some cynicism when it comes to crypto or digital assets because people think back to what happened in 22. But actually, when you look at these numbers and you think about gold specifically, it's actually done very, very well.
Yeah. Thank you, Alex. And then we do the same exercise going back to 2017. Again, a high point for Bitcoin, a major high point for Bitcoin. I've very specifically chosen these periods to illustrate the point, because some people have written and saying, well, why are you choosing these dates? So, obviously, if you choose the major Bitcoin lows, you're better off just owning Bitcoin. No one's going to dispute that. If you were going to buy Bitcoin at 5,000 in 2020 or something like that, then Bull's not going to do as well because it's a much calmer approach. But if you own if you own Bull instead of Bitcoin at any other time, when it's hyped, then you're much better off over time. And here we've got the calculation that the split, Bitcoin up 255% over that 6.5-year period, gold up 84%. The split takes you to 126. The gold is to 186. So 60% better off in the bold strategy than in the unrebalanced mix. And the reason it works it's very simple, that you're basically always buying the weaker asset. So if you believe in both assets over the long term, you're always buying the weaker one and selling the richer one when there's a material difference in the rebalance. Then you accumulate the assets accordingly. So in 2018, when Bitcoin collapsed, you were adding to your Bitcoin. And this is $1 million hypothetically engaged in the gold strategy, whilst you were funding those purchases with gold. Your gold is going down all the way to 2020 until Bitcoin starts surging, at which point you've got loads and loads and loads of Bitcoin, which is great. But then as it starts surging, you're letting go of it, you're adding to gold. And by the time the Bitcoin bear market comes in 2022, you've got loads of gold and less Bitcoin, and so you flip. And this whole process of being counter to what's going on in two assets that have low or negative correlation, which you believe both for the long term, just works. It wouldn't work in gold and silver. It wouldn't work in Bitcoin and Ethereum. It wouldn't work in French and German equities. It wouldn't work in many things. It should work in equities and bonds, but not when they're correlated like they are today. So it did work for a couple of decades, or 3 decades, from 1982 right up to the credit crisis, and probably a little bit beyond as well. But certainly now, this is a real window where we've got this wonderful low correlation between the assets. And then the other point I'd like to make is, why Bitcoin? Why not Bitcoin, Ethereum, and all the other stuff? Where's Dogecoin and Shiba Inu? And it's like, well, do you really want that? The point about Bitcoin is an alternative asset that's hugely liquid, much more so than all of the others. It's got more liquidity than all the other crypto put together. It's a massively liquid asset, and it stands out, and it's probably worth 3 times more than the next one. And so I just don't think you want crypto in this basket, because this basket is a macro basket, and Bitcoin is over 50% of the entire crypto market, of which 10% is US dollar stablecoin. So it stands out as the elephant in the room, as does gold for commodities. And gold is the only. Gold's really, really liquid, $145 billion a day, coming up to the S&P 500, and that is just monstrous. And if you add silver, you're adding volatility, lots of volatility, and you're taking away liquidity from the mix. So you just want the pure player, Bitcoin and gold, in this strategy. And I show there against the Mag 7, it is no surprise that the big correlation between tech and Bitcoin has always been there. It used to be more social media centric, but now it's probably just more broader tech, as Bitcoin has more and more applications and different associations in different markets around the world. But basically, board is your alternative. Sorry, Bitcoin is your alternative way of playing tech, in simple terms. Just as gold is your alternative way of playing the entire commodities market. And here I put it against copper, which has been in the news recently. Gold and copper, so similar over the last year and a half. Interestingly, if you go back to 2020 during the COVID crash, gold went down a tiny bit, copper went down a lot. And so that's what I mean by a risk-off asset. Gold during times of crisis really doesn't impact you historically has not impacted nearly as much as other things. It could still go down in a crisis, but just nothing like as much as other stuff will go down in a crisis. So I think just to have gold and Bitcoin makes a lot of sense. Alex, what do you think of this table? Can you explain what this table means?
This is your asset class return since 2015. Looking at some of the world's major equity indices, and what I actually love about this chart is when you look at those gold and Bitcoin numbers and the bold numbers, and you compare them to how traditional assets have done, and you look at those return, the bottom row. I mean, it's an incredible numbers there. I mean, the Bitcoin number kind of blows me away. But how many people were invested in Bitcoin in 2015, I guess. But that number blows me away. But you just look at the bold number, 634%, over that nine-year period, just incredible.
Yeah, I think the other point I'd like to make is that Bitcoin has these amazing years, and then it has a disastrous year, and gold's always on the other side of it. It's gold is very rarely very unlikely to be troubled when Bitcoin's troubled, and it's very unlikely to be excitable when Bitcoin's excitable. And that's why the bold column has got no blue or red. It's never the best, it's never the worst. It's a very steady strategy. The bear market.
Yeah, I mean, when I look at those, so that big the crypto winter, 2022, right? So we had Bitcoin down 64%. that's quite striking to me. Bold was only down 15%, but then you look at the Nasdaq, you look at the S&P, you look at the Swiss market, down or more than Bold. Similarly, 2018, another, the down cycle before that. Bold held up very well and actually, outperformed some of the core developed markets. So, I think it's showing here how resilient Bold has been, regardless of what's happening in traditional markets.
Thanks, Alex. Now we've got a couple of slides left, and then we'll go to a Q&A. So if you want to start putting your questions in, then please do so. But I'll finish off with some risk slides. Looking at Bitcoin volatility. Now we've got the big tech stocks in there. Bitcoin is the black line, and more volatile than Bitcoin is Nvidia. Meta is about the same, or just slightly higher, and of course Tesla. No surprise there. But of the seven biggest stocks in the world, Bitcoin is less volatile than three of them. I don't think many people know that. And then you've got Amazon and Google and Microsoft and Apple, who are all slightly lower. Apple and Microsoft, of course, are much lower. But Bold is materially materially less volatile than all of those stocks. And outside Nvidia, it's outperformed. So there you have it. And then just to put Bold not against super tech stocks, but just against the world's highest quality companies, Berkshire Hathaway. What have we got there? Move my cursor. Nestle, Unilever, JP Morgan. I just throw in there for the world's largest bank, not necessarily a high quality by definition. I'm not being rude about JP Morgan. It's a bank, and Procter and Gamble. Bold is slightly more volatile than the world's most high quality companies. So I'm just sort of framing that this strategy is not particularly volatile by any means. And then to sort of summarize where we are, Bold Index combines Bitcoin and gold on a risk adjusted basis. There's rebalancing every single month, which is a discipline that's very hard to do. It's expensive for most people to do, and it could involve taxable events if you didn't do it properly. And it's very difficult to do emotionally as well. It's easy to think, oh, that's not worth doing. It's a small one this month. Don't bother. And it's also, it's very easy to not do it for emotional reasons. Like, so I'm not sure about gold this month. I'm not sure if I want any more. I've lost faith in it or whatever. With a rebalancing strategy, you just got to do it. And the objective really is an optimal way to own these two assets side by side in the long run. And it certainly is. The plan is to enhance gold. And I don't think it's going to lag Bitcoin much, if at all, over the next 10 years. I really don't. I think there's going to be magical things happening in crypto. But I just think that Bitcoin's is going to slow down to a point that if the cyclicality remains, then Bold will have enough time to more or less keep up. Certainly on a risk-adjusted basis, it will be a much better bet than owning Bitcoin and gold independently.
Charlie, for any kind of wealth manager, this is a fantastic diversifier as well in the portfolio.
Yeah, absolutely, it is. It's a shame that it's sort of hard to access. But we're talking about the Bold Index, really, aren't we? So, I think provided you can get exposure to gold, which is easy, Bitcoin is a bit more difficult. But it's something that you should try and embrace. Well, Alex, look, thank you very much for joining us today, and thank you to the audience for putting up with us for the last 40 minutes.
And Charlie, thank you very much for inviting me to be on. It's an honor to be here with you, and all the work we do together. From a 21 Shares perspective, we really value the partnership. It's a great partnership. Bold is a product which personally I'm very excited about. I think it should be in every portfolio. Let's keep the work going.
He's a bit overdressed, isn't he? Other than that.
Bye.
Cheers, Alex. Thank you all.
Bye.